Welcome to ETF Explained, a series on the Get Started Investing podcast. Each episode we explain one ETF to better understand it and to help you build the skills to analyze an ETF. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Very excited to dive into this ETF. Today we're looking at JPMorgan Equity Premium Income Active ETF managed fund. The ASX ticker is JEPI, JEPI. We actually heard before it's the world's largest active ETF because it's not just in Australia, it's also over in the US. And luckily for us, all the way from the US, we have the portfolio manager of that ETF and of a couple of other active ETFs that we're going to be talking about in coming episodes. He's also the Chief Investment Officer of US Core Strategies at JPMorgan Asset Management. Hamilton Reiner, thanks for joining us.
Oh, thanks for having me, guys. I'm very excited to talk.
Brought in the big guns for this one. So
I'm not sure I've got the guns.
So Ren, let's start as we always do with the name. JPMorgan Equity Premium Income Active ETF Managed Fund. A lot to unpack there. So let's start with product issuer.
Yes, JPMorgan Asset Management.
Pretty straightforward.
Yeah, as we go through the name, equity tells us what it's investing in. Equities.
Yep.
Focus of the fund is in the name as well. There's income, but there's also a bit of growth that comes from investing in equities. But then importantly, the investment style is also denoted in the name. It's an active ETF. It's not passively tracking an index. So as we start off, there's a heap of information we can get from the name. But Hamilton, we're then going to get in under the hood, I guess, into the ETF itself. And we always like to start with what the purpose of this ETF is. So can you help us understand what JEPI's purpose is?
Sure. It's in the name, income. And income is one of those things that never goes out of style. And to be able to generate some income with an active portfolio of high quality names, the type of names you would want to own, like an Amazon or a Microsoft or a Visa or MasterCard, we think is really a helpful way of building a portfolio of income, but still owning high quality stocks.
And so Ren mentioned there that it's the asset is equity. So how do you think about capital appreciation in this ETF as well?
So because this strategy does have some equity exposure, we expect this strategy to have some equity market exposure, but we will forego some of the returns of the market because we're going to take that bird in the hand of income in order to trade off or potentially give up some of the upside. So you will get some income from a strategy like this, some dividends, and some market participation.
And I think we should explain that because some of the companies that you spoke about, they're sort of these big, well-known US companies, but they're not perhaps known as the biggest dividend payers on the market. And that comes to the strategy that you've got here, which is involves options as well to generate that income.
Sure. So yes, when you think about options, options are something that have been around for decades, actually centuries. And what we're doing is something that's nothing new. It's been done by folks for years and years, farmers actually. When a farmer would actually plant crops, they would say, if someone's willing to buy my crops in 3 or 4 months from now for, let's call it $6 an acre, and it's going to cost me $3, I know I can capture the difference, 6 minus 3. So with a strategy like this, we're going to sell an option that will potentially forego some of the upside of the appreciation of the market in return for having that bird in the hand of income today. So the idea is let's own a group of high quality stocks, as you said, US stocks in particular, that are well known, more defensive, stocks that actually should hang in pretty good in both up and down markets. And then the income is just a nice kicker to help people accumulate wealth over time.
So that's the purpose of the ETF, and then we've touched briefly on the strategy or sort of how you achieve that purpose. I think the next question we really like to understand is how it's intended to fit into an investor's portfolio.
That to me is one of the elegant things about this strategy. There's a variety of different ways that this could fit into a portfolio. The first way is given all the market turbulence that we're seeing today, it's a conservative way of getting invested in the U.S. equity market. high quality names, throwing off a fair amount of income, above average level of income. We anticipate this strategy through a cycle having 7 to 9% of distributable income. So it could be a nice conservative way of getting exposure to the U.S. equity market with income. It also could be a way to invest in a variety of different market environments, perhaps have a very good return profile. Because one of the nice things about this strategy is there's multiple ways of adding value to your portfolio. In a pure equity-only strategy, it's either you win and it goes up or you lose and it goes down. Because we're generating some income and we actually have this higher quality portfolio, this strategy could work in a variety of market environments. In an up market, we should do quite well. We may not keep up with the market because we're going to forego some of that upside of the market participation for that income that we're getting in. In a flat market, you're still going to get a pretty healthy level of income, that's 7 to 9% through a cycle. And if the market goes down, we'd expect this higher quality group of stocks, plus the options premium, the income, to help buffer some of the downside. So this strategy could work in a variety of different markets, which is quite exciting from an investor perspective.
So one of the things that we look at when analyzing an ETF is the index or the benchmark that it tracks. So what benchmark do you guys use?
So the benchmark that we have is the S&P 500. But the portfolio is very different than the S&P 500 because we're looking for those stocks that have very predictable earnings. Those stocks that aren't going to surprise you on a quarterly basis as to what they earn. Think about it. We all have plenty of boxes on our doorsteps from Amazon. They're going to probably hit their numbers consistently, or even Visa and MasterCard. I mean, we're all stuck with those credit cards and tapping. They're pretty solid as far as their ability to generate earnings. So the benchmark is the S&P 500, but relative to the S&P 500 is how we really think about the strategy. We expect it to have a lot less market risk, a more conservative way. Think about it as having perhaps 35 to 40% less market risk than just the index.
Now, a couple of other boxes we like to tick as we go through the exercise of analysing an ETF. One is fees, and you can look on the JPMorgan Asset Management website and see it's 40 basis points or 0.4%, which is the equivalent of 40 cents for each $100 invested, which I think in the scheme of things is quite reasonable. Yeah. So, but don't raise them.
We won't.
But then another thing we like to look at, which is also available on the ETF issuer's website, is performance. Now, this ETF has been listed since November 2022 in Australia. And for the 1 year returns, we can see 8.73%, including dividends, compared to 23.62% for the benchmark. So that, you were talking earlier there about how you forego some of the upside, and I think that's showing through there. But as we mentioned earlier, JEPI's been listed for a lot longer overseas. So can you talk to the performance longer term overseas and how you see it's gone?
Sure. So overseas, the ETF has been around since May of 2020. Pretty interesting time to launch a strategy, smack dab in the middle of COVID. And it has performed, over time, pretty much as we would expect. As I highlighted earlier, it's going to be more conservative, having about 35 to 40% less risk than the overall U.S. market. But interestingly enough, as I highlighted earlier, there's multiple ways of winning, if you will, with a strategy like this when you put it into your portfolio. In a year like 2021, the market was up 28 and change, and our strategy was up 21 and change. About 8% of that was income, and another 13% of market participation. So that nice balance of upside and income. In a year like 2022, which was a real challenge for all of us, this strategy was only down 3.5% with the market down 18%. That higher quality portfolio, once again, using active to be a benefit to our investors, doing stock selection, not buying a passive index was a nice benefit. Plus, bringing in that income helped buffer some of the downside. So being down only 3.5 for the market down 18 is pretty good. But the other way we talk about the strategy, I think, actually to complement investors is when we end up in those periods of time where the market's very range bound, it's a nice way of just clipping those dividends and options premiums for our investors. So the strategy's done what it has been expected to do since inception. And as we've seen more recently, markets are a little bit volatile, and on those down days, it's really kept our investors invested.
Nice.
Now, the fund pays monthly distributions and...
Love that.
Yeah, love that. And on a 12-month...
For only 40 bips.
Yeah, I know. How good.
I'm kind of interested. So on the 12-month rolling distribution yield is 6.26%. So when we look under the hood, Hamilton, it's really important we understand what we're buying, not just understanding the name and then going for it. And so to do that, we often look at the top 10 holdings. Now, the top 10 holdings of this ETF look quite different to the S&P 500. We've got number one holding is the Progressive Corp security number 74331510.
I don't think worry about that.
And they go on. Can you explain how you actually construct this portfolio and why some of these top holdings might look a little bit confusing for some people?
Sure. When you think about what we're trying to accomplish in our stock selection, we're looking for those higher quality, blue chip type of securities, those stocks that will hang in better when the market sells off, but also participate in some of the upside. And if you see the rest of the 10 names, like Progressive is a very well-known insurance company.
Yeah, I was
going to
say, Bryce mustn't watch a lot of American sport because I feel like even I know Progressive.
None of it.
I mean, it's flow.
Yeah.
And when you look at some of the other holdings, I mean, they're very much household names, you know, Amazon and Meta and Google and MasterCard and AbbVie. I mean, these type of names, we really want to own those household names, those names that people would like to own, even without the income that we're giving them. So this portfolio is actively managed and is designed actually to be different than the S&P 500, not because the S&P 500 isn't wonderful, it is, but we'd rather give our investors a more conservative approach to investing because the most important thing when it comes to investing is not just being able to make money when it goes up, but also help you lose less when it goes down so you stay invested.
Just one other question on the top 10 holdings. It looks like they all are sort of around that 1.5% weighting. The Progressive is 1.65%, Train second highest 1.6%, and then your 10th biggest holding is 1.44%. So they're sort of all clustering around that. Is there a reason to that?
Yes. So today, actually in the U.S. market, as well as in most global markets, there's a pretty big concentration risk in investing. Top 10 names in the S&P 500 right now are over 30% of the weighting. So in designing this strategy, we said we want to have our chips spread across the table. We want to have a lot more names with a lot less individual stock risk. So it's intentional to have no more than 2% allocated to any individual name. The portfolio is going to have between 120 to 130 names on average. And our goal is to get a lot more of the stocks right than wrong, but let's actually not be overly concentrated in any 1, 2, or 3 names, really spread it out across all of them which we own.
Love it. Well, Hamilton, it's a fascinating ETF. It's JEPI, the ticker, if people want to look it up. It is the world's largest active ETF. Which is pretty crazy that it only launched in mid-2020. So you must be
very
loving
honored
it.
to be running this strategy.
And we're stoked that you've taken what worked in the US and brought it to Australia. Sometimes we're the forgotten little brother down here. So it's great that JPMorgan Asset Management have brought it to Australia. But what is also great is that you're going to be joining us for a couple more episodes. We're going to be talking about JPEQ, another active ETF, and JEGA. So if people enjoyed hearing Hamilton, make sure you're subscribed because he'll be back for 2 more episodes. But until then, Hamilton, thanks for joining us today on Get Started Investing.
Thanks for having me, guys. Truly appreciate it.